Today, Cryptocurrency Academy will tell you the history and rises and falls of Ethereum in a very human way. We will not start with dry technical terms. We will start with a question that can keep people awake at night. If Bitcoin was the first cryptocurrency to prove you could move value without a bank, then what happens if you can program money, program contracts, program an entire financial system that runs on code? Ethereum was born from that ambition. And when ambition meets the market, everything becomes both brilliant and brutal. Because the moment price begins to form, people change faces. People start with hope, then greed, then fear. Ethereum is not only a technology project, Ethereum is a mirror that reflects crowd emotion from its earliest days. Crypto Explained is the way we tell this story, because Ethereum has always been as much about human psychology as it is about code. Go back to the 2013 to 2014 period, and you will see Ethereum beginning as an idea bigger than creating a coin. At that time, the crypto community was still small. Many people saw Bitcoin as digital gold, but they also saw a limit. Bitcoin was not designed to easily run complex applications. If you want to build something like a lending market, a game, a decentralized exchange, or a contract that automatically pays when a condition happens, you need a more flexible foundation. Ethereum arrived with a promise. Create a blockchain platform that can run smart contracts, meaning pieces of code that execute themselves with no middleman. The idea sounds beautiful, but a beautiful idea is not guaranteed to survive, because survival always has to pass through one door. Does the community trust it enough to put time, money, and effort into it? Crypto Explained starts here because this is where belief begins. To turn the idea into reality, Ethereum needed resources. And this is where the fundraising story appears, but we should call it by its real nature, a community crowd sale. Around the middle of 2014, Ethereum ran a crowd sale where people who believed in the project sent funds to receive ETH, with the expectation that the network would be launched and ETH would have value. The mindset back then was very different from today. There were not thousands of ICO projects like in the 2017 era. There were no influencers screaming hype. Most participants were extremely curious about the technology and willing to take very high risk. Some people treated it like buying a ticket into the future. Others stayed skeptical and thought it was only a bold experiment. But no matter which side you were on, the crowd sale created something crucial. For the first time, the market started to assume ETH could be priced. Crypto Explained keeps it simple. Once something can be priced, it can start to mess with the mind. From 2014 until Mainnet arrived, Ethereum lived in a state like a movie being filmed but not yet released. There was a community, there were updates, there was expectation, there were arguments, and there was also a quiet fear that everything could collapse before it truly began. This was a period where many people worked not for price, but because they believed they were building something that could change how the world transacts. But price was always a shadow behind them. Because if one day Ethereum ran for real, ETH would be traded for real. And once it is traded, it is no longer just a moral story about decentralization. It becomes a psychological game, where people can put money in simply because they fear being left behind. Crypto Explained is not here to hype it. Crypto Explained is here to show what price does to humans. On July 30th, 2015, the Ethereum network officially launched. For builders, this was a historic milestone. For the market, this was the moment ETH stepped into real life. In the early days, liquidity was thin, exchanges were few, and news had not spread widely, so the price behaved in a very wild way. In some stretches during the months after Mainnet went live, ETH traded below $1, around $0.70 to $0.90, and sometimes pushed above $1, depending on the exchange and the day. These numbers sound small if you look from today, but psychologically, it was a massive leap. ETH was no longer a white paper file or a promise. It was something you could buy, hold, and sell. And that moment is also when risk finally gained a clear shape. Crypto Explained repeats this because the first real price is the first real temptation. To understand why Ethereum feels different from Bitcoin for users, you have to understand one concept that will follow Ethereum for life: gas. On Ethereum, you are not only sending money, you are also running contracts. Running contracts means using computing resources, and resources cost fees. Those fees are called gas, paid in ETH. This creates a strange link. ETH is both a speculative asset and fuel. As the ecosystem grows, demand for gas rises, demand to buy ETH to use rises, and the price story gains a real engine. But in 2015, that was still only a seed. Many people bought ETH then, not because they needed gas. They bought because they believed that one day, thousands of applications would run on Ethereum, and ETH would become something essential. Crypto Explained says it plainly: a fuel asset creates a different kind of belief, and belief is what feeds the next wave. Our illustration story begins with a fictional character who is psychologically real. Ethan Brooks, 32 years old, living in Washington State, working as an IT technician for a small company. Ethan is not a gambler type. He reads, follows the community, and gets pulled in by the idea that Ethereum could become the foundation for a new generation of applications. Ethan decides not to go all in, but also not to stay outside. On August 15, 2015, Ethan buys 6,000 ETH at about $0.80 per ETH, totaling about $4,800. He tells a friend he is buying not because he thinks next week will pump, but because he thinks a few years from now Ethereum could explode. But humans always have a weakness. Even if you call yourself long-term, you will still watch the price every day. And when you watch every day, emotion has a chance to bite you. Crypto Explained highlights this because the first trap is rarely technical. By early 2016, Ethereum started to produce rallies that made people jump. The ecosystem became more active, more experiments appeared, and the smart contract story spread wider. In parts of the first quarter of 2016, ETH rose dozens of times from its earlier levels. On the hottest days, ETH moved into the $10 to $15 range, creating the feeling that this could be Bitcoin, but for applications. Ethan watches his account grow from $4,800 into tens of thousands. On March 13, 2016, if ETH is around $14, Ethan's 6,000 ETH would be worth about $84,000. This is the moment the market starts whispering the most dangerous sentence: what if I just hold a little longer? And those words, a little longer, have destroyed countless people later. Crypto Explained is showing you how greed begins to sound reasonable. But Ethereum did not rise only because of fantasy. It rose because a very real frenzy began to form: the DAO. The DAO was a bold idea, like an investment fund operated by smart contracts, where the community contributes money and votes on decisions. At that time, it felt like a dream of decentralized finance before the word DeFi became mainstream. People did not buy ETH only because they expected price gains. People bought ETH to participate in the DAO, to contribute to an experiment they believed could change how fundraising and investing work. That frenzy pushed demand for ETH higher, and the price ran hotter. And when a market rises on a story, it often forgets one thing: security. Smart contracts are code. Code can have flaws, and flaws in finance are disasters. Crypto Explained treats this as the moment the bill for innovation started coming due. In June 2016, the shock arrived. The DAO was attacked. To outsiders, it looked like a robbery in a digital world. To the community, it was a crisis of trust. If Ethereum is the platform where people send value into contracts, and contracts can be exploited, then where does the future go? The price reaction was brutal. Earlier, ETH had pushed above $20. Then after the shock and panic, ETH could drop hard into single digits, sometimes around $10, and even lower depending on the wave of selling. For the first time, Ethan understands the feeling of being high in the air and suddenly losing the ground. He starts hearing the familiar lines: Ethereum is dead, smart contracts are dangerous, anyone still holding is foolish. And when the market shouts those lines the loudest, that is usually when holders start shaking. Crypto Explained repeats this because crashes are not only about numbers, they are about identity, shame, and fear. The DAO crisis was not only about money lost. It created a moral and technical question that split the community. Should the consequences of the attack be reversed or not? One side said the blockchain should be immutable. What happened must stand. The other side said if there is no intervention, trust in the entire ecosystem could collapse. In the end, the choice led to a split. Ethereum continued in a direction that fixed the outcome, while another branch kept the original history and lived on as Ethereum Classic. This was the moment many people first understood a truth about crypto. Decentralization does not mean there will be no conflict. Decentralization means conflict will happen in public, and you will have to choose what you believe. The market hates uncertainty, so the price kept whipping. Crypto Explained points to this moment because it shows how governance becomes a battlefield when there is no single boss. Back to Ethan in Washington, this ending is deeply human. After the DAO shock and the chaos of 2016, Ethan no longer feels like a smart investor. He only feels pulled back and forth by news and emotion. But he also remembers why he bought in the first place. Not for a week, but for an idea. On July 20th, 2016, right when the controversy and the split were at their hottest, Ethan decides to take some profit just to save his nerves. He sells 2,000 ETH at about $11, receiving about $22,000. Compared to his original $4,800, he is still up massively. But compared to the peak value he once saw on his screen, he still feels pain like a loss. And that is a major lesson. Sometimes you are profitable and still hurt, because your mind does not compare to the starting point. It compares to the peak you failed to sell. Ethan keeps 4,000 ETH and accepts that many storms may still be ahead. And that is the spirit of early Ethereum. It is not a straight line up. It is the story of a huge idea entering real life, being priced, being ignited, then getting slammed by a security shock and a controversy that cracked the community. But Ethereum is still alive. And when something stays alive after its first real shock, the rest of the story usually gets far more intense. Crypto Explained will continue because the next waves are bigger, the stakes are higher, and the emotions get sharper. After the DAO shock and the split that cracked the community, Ethereum entered a strange phase. Trust was damaged, yet the opportunity was bigger than ever. Because after a crisis, the market does not only ask whether Ethereum can survive. The market starts asking a sharper question. If Ethereum can keep running, can it become a real foundation for an entire ecosystem? And that question pulled in a new wave of people. Not everyone understood smart contracts, but they understood one simple thing. If there is a platform, there will be projects. If there are projects, money will flow in. And if money flows in, price will run. From here, Ethereum's rises and falls were no longer just an internal story for tech builders. They became a global crowd psychology story. Crypto Explained is here to make that clear, because this era is where emotion scaled up. From late 2016 into 2017, Ethereum started to be seen as the field where projects could raise capital. You heard the term ICO more and more. Many projects openly said they were issuing their tokens on Ethereum, using smart contracts to sell those tokens, and using ETH as the way to receive funds. This created a powerful loop. The more ICOs there were, the more people needed ETH to participate, the more buying pressure appeared, and the more price got pushed. And when price got pushed, mainstream coverage grew louder. New people felt more fear of missing out, and the cycle fed itself. You have to understand one thing. In a bubble, real technology can exist, but money usually does not wait for technology to mature. Money only needs a story. And the 2017 story was easy to sell. Ethereum is the platform of the future, and buying ETH today is buying a seat in that future. Crypto Explained repeats this because bubbles are built from stories, not spreadsheets. Price began to reflect the crowd mindset perfectly. In 2017, ETH rose hard in multiple waves, and each wave pulled in a new layer of newcomers. There were moments early in 2017 when ETH was still in the double digits. Then it climbed into the hundreds of dollars, and by late 2017, it pushed toward the $1,000 zone. You do not need to memorize every number to understand what mattered. You only need to remember the feeling. Every week came with a new life-changing story. People flexed profits the way they flexed intelligence. And when people flex profits, the market turns into a stage. Many newcomers entered not because they studied, but because they feared being the only person left outside. This is when greed wears a beautiful mask, the mask of long-term vision. People say they buy for the future, but in truth, they buy because they see price rising and they want it to keep rising. Crypto Explained calls this the moment hope turns into a crowd stampede. The first illustration story in this part is about a person in the United States, so you can see clearly how a bubble works. Let's call her Olivia Carter, 29 years old, living in Florida, working in marketing. Olivia does not hate risk, but she also does not think of herself as reckless. She heard about Ethereum through friends at a party in late 2017. Everyone talked about ETH like it was a train that everybody had to board. Olivia went home, looked it up, read a few articles, watched a few videos, and saw people everywhere saying Ethereum was the foundation of Web3 and the future of finance. And then came the familiar moment. Olivia asked herself, what if I buy today and it doubles? That question makes people move faster than reason, Crypto Explained. Highlights this because the most dangerous decisions often start as innocent questions. Olivia decided to buy right when the market was at its hottest. On January 15, 2018, she bought 10 ETH at about $1,200 per ETH, totaling about $12,000. This was a big chunk of savings for her, but she calmed herself by saying she was investing in the future and Ethereum could not disappear. For the first 2 weeks, Olivia lived in a constant habit of checking the price. If price ticked up, she felt right. If price dipped, she told herself it was only a pullback. But a bubble market has a cruel habit. It gives you the feeling of certainty right before it changes direction. And when it changes direction, it does not ask if you are ready. 2018 was the year a lot of people learned what crypto winter really means. After the peak, ETH fell hard, and it fell for a long time. Not the kind of drop that hits for a day and then bounces. This was a series of drops, and each drop extinguished another piece of hope. Throughout 2018, ETH could fall from above the $1,000 region down into the hundreds, and at times by late 2018, it sank into the low hundreds. For Olivia, every time the price fell, she thought it would surely recover soon. But the market does not care what you think. It reflects flows of money and the total emotion of the crowd. And when a bubble bursts, money pulls out and emotion flips from greed to fear. Fear makes people sell to reduce pain, and the more they sell, the more price falls, creating a self-destructing spiral. Crypto Explained emphasizes that this is not just math. This is mass psychology. Olivia held on for months, then she started losing sleep. She avoided opening her app because every time she opened it, she felt poorer. By December 15, 2018, with ETH around $90, Olivia could not take it anymore. She sold all 10 ETH at about $90, receiving about $900. From $12,000 down to $900, that kind of collapse shocks people not only because of the money, but because it destroys confidence in their own judgment. Olivia told herself Ethereum was a scam. She hated crypto. She swore she would never touch it again. And this is what happens to many people. They do not only lose money, they lose confidence. And once they lose confidence, they exit the market right when the cycle is near the lowest point. Crypto Explained says it plainly, the market can take more than your cash. It can take your courage. But in 2018 to 2019, Ethereum did not stand still at all. While price was being crushed, the ecosystem kept developing in a quieter, tougher way. Trash projects from the ICO era got washed out. The people building real things stayed. The concept of DeFi started to form more clearly. Lending, swapping, liquidity providing, all running on smart contracts. And the interesting part is that DeFi needed Ethereum the way a city needs roads. It needed a foundation people could trust, a large developer community, and assets with liquidity. This is a period where outsiders looked at price and said Ethereum was dead, but insiders looked at the work and saw the foundation being built. The market is often blind. It treats price like the final truth, while the truth of technology usually moves slower than price. Crypto Explained keeps repeating this because the quiet years are where the next explosions are prepared. The second illustration story is about Marcus Reed, 35 years old, living in Texas, working as a mechanical engineer. Marcus did not buy at the top the way Olivia did. He entered after he had already watched many people get burned. He said it directly. "I do not believe in the get-rich-quick story anymore. I only want to try a disciplined approach." On February 20th, 2019, Marcus bought 30 ETH at about $140, totaling about $4,200. He did not brag. He also did not expect an instant moonshot. Marcus set a rule. If ETH rises hard, he will sell a portion to lock profit. If ETH falls, he will only hold, not sell from fear. It sounds simple, but the hardest part is doing it when emotion shows up. Crypto Explained uses Marcus to show that survival is not talent, it is behavior. During 2019, ETH had periods of strong recovery off the bottom, sometimes pushing into the few $100 range. Marcus saw profit and felt greed trying to wake up. But he tried to stay disciplined. On June 26, 2019, with ETH around $320, Marcus decided to sell 10 ETH, receiving about $3,200. He did not sell everything because he still believed long-term, but he sold a portion to reward himself for following the plan. Why is selling a portion powerful? It reduces obsession. It reduces risk. It reduces how much the market can control your mood. Marcus kept 20 ETH and continued watching the ecosystem. And this period helped him see clearly that Ethereum is not just a coin. It is a platform with more and more real users. Crypto Explained points to this because the strongest habits are built in the middle of a boring year. Going into 2020, the world took a different shock, the pandemic and a global market crash. Crypto did not escape. March 2020 is remembered by many because prices fell very fast. But from 2020 onward, DeFi also grew much more aggressively. Usage of Ethereum increased, and the gas story started becoming a hot topic because fees got high. This is the dark side of success. The more users, the higher the fees, and the community starts arguing again about scalability. But in the big picture, 2020 was the year Ethereum proved it was not living only on speculation. There was real economic activity on-chain. Borrowers, lenders, traders, and people earning yield by providing liquidity. This is what a purely narrative bubble does not have. Crypto Explained stresses this because real usage changes the meaning of price. So what does this part conclude? Ethereum went through a cycle that most newcomers cannot endure. The ICO frenzy drove price to a peak, then crypto winter dragged price down close to ashes. Olivia represents the people who arrived late, bought from FOMO, sold from panic, and left with a psychological scar. Marcus represents the people who entered after the crash, understood risk better, stayed more disciplined, and knew how to sell a portion to survive. Most importantly, while humans moved up and down with emotion, Ethereum kept moving forward because builders kept working. Price can be noise, but infrastructure and real users are the signal. And when you understand the difference between noise and signal, you start to understand Ethereum in a mature way. Crypto Explained ends this part with one clear line. The next era gets even more intense. DeFi explodes, NFTs explode, gas fees spark controversy, and Ethereum prepares for the biggest transition of its life. From here, Ethereum's story enters the period many people call the real breakout. It is no longer just a platform with potential. Ethereum starts becoming a place where clear, visible economic activity happens. You do not have to be a programmer to feel it. You only have to watch how people use Ethereum to borrow, lend, trade tokens, earn yield by providing liquidity, and then later buy and sell digital assets like NFTs. Ethereum becomes a crowded city, and when a city gets crowded, it gets traffic. Ethereum's traffic is gas fees. Every time activity spikes, fees spike. And when fees spike, arguments spike. People who love it say it is proof of success. People who hate it say the system is unusable. But the key point is this: no matter how loud the debate gets, Ethereum keeps running, keeps attracting users, and keeps pulling both money and attention from the wider financial world. Crypto Explained is about that reality, not the fantasy. In 2020, DeFi is no longer a vague concept. It starts showing numbers big enough that outsiders have to pay attention. Lending protocols, decentralized exchanges, stablecoins, yield farming, all of it creates a game people can join directly without a bank. And that is exactly why emotions explode. Some people see it as real financial freedom. Some people see it as a way to print money with a few clicks. And some people see it as a minefield. The truth is, it is all three. DeFi shows that smart contracts can replace part of traditional finance, but it also shows the risk of code. One small bug can wipe you out. And when more money flows through Ethereum, questions about security, audits, and responsibility become sharper than ever. Crypto Explained has to underline this, because the bigger the opportunity, the sharper the consequences. The first illustration story in this part follows an American character so you can feel how the DeFi wave actually hit people. Let's call him Daniel Harper, 31 years old, living in Colorado, working as a data analyst. Daniel entered crypto out of curiosity, but he stayed because DeFi pulled him in. He read about providing liquidity and earning trading fees. He heard about yield farming as a way for money to make more money. On August 18, 2020, Daniel decided to buy 20 ETH at around $430 per ETH, about $8,600 total, with the goal of using ETH as fuel to participate in protocols. Daniel did not buy for a quick flip. He bought because he believed DeFi would increase demand for Ethereum, and ETH would sit at the center of that entire machine. Crypto Explained is showing you the mindset of someone chasing utility, not just price. In the first few months, Daniel felt like he had found a money machine. He provided liquidity, collected rewards, and watched his balances grow day by day. But then he ran into what many newcomers do not fully understand: gas fees. Some days Daniel wanted to withdraw, swap, or adjust a position. And the gas fees were so high that he hesitated. Daniel started to understand the core paradox. The more successful Ethereum becomes, the more crowded it gets, and the more expensive it becomes to use. He felt happy because the ecosystem was alive, and angry because the fees made the experience painful. But Daniel stayed because he could see real demand rising. He could see people were not just talking about DeFi, they were using DeFi. And when people use something, money and attention follow. Crypto Explained keeps coming back to this point because usage is the kind of truth hype cannot fake for long. By 2021, Ethereum enters another wave that is even louder: NFTs. If DeFi is about money, NFTs are about culture, brands, and emotion. You watch people buy images, buy digital items, buy the right to flex, buy the feeling of owning something unique. NFTs push Ethereum into mainstream headlines, social media feeds, and conversations among people who never cared about blockchain before. But at the same time, NFTs expose the dark side of excitement: trash projects, scams, rug pulls, and ridiculous promises. The market repeats a familiar pattern. Real technology creates real opportunity. Real opportunity attracts greed, and greed attracts bad actors. Crypto Explained is not here to pretend it was all beautiful. Crypto Explained is here to show you what really happens when the crowd arrives. The second illustration story follows Emily Nguyen, 28 years old, living in California, working as a freelance designer. Emily did not care much about DeFi, but NFTs grabbed her because they touched art and community. On May 10, 2021, Emily bought 5 ETH at around $3,900 per ETH, about $19,500 total. She believed she was buying an entry ticket into a new trend. Emily used part of her ETH to buy an NFT in a collection that was going viral. She believed it would rise fast because everyone was talking about it. For a few weeks, floor prices climbed, group chats went wild, and everyone bragged about profits. Emily felt something dangerous, the feeling that she had finally caught the right wave. Crypto Explained highlights this feeling because it is often the moment the market starts setting a trap. But NFTs can slap you fast. When the market turns, liquidity disappears, floor prices drop, and the people who were shouting yesterday suddenly go silent or vanish. Emily realized she was holding something she believed was an asset, but the price depended heavily on crowd psychology and new money coming in. By June 22, 2022, as the crypto market sank deep into a brutal downturn, ETH was around $1,100 at points. Emily panicked as her account kept bleeding and decided to sell 3 ETH around $1,100, bringing in about $3,300 to protect what she felt she could still save. Compared to her $3,900 buy price, it was a painful loss. But the deeper pain was feeling tricked by the earlier excitement. Emily did not only lose money, she lost trust in her own judgment. Crypto Explained repeats this because the biggest scars are usually psychological, not mathematical. While users are riding emotion, Ethereum keeps moving forward with the biggest story of all in terms of technology and trust. Changing its consensus engine, before, Ethereum relied on mining like Bitcoin, known as proof of work. But for years, the Ethereum community aimed for proof of stake to cut energy use and build a foundation for scaling. This was not a small change. This was changing the engine of the entire car. And when you change an engine while the car is still moving, the risk is enormous. But if you succeed, the benefit is enormous. The important detail is that this transition took many years, with multiple upgrades step by step, and constant pressure hanging in the air. If it fails, it could become a historic disaster. If it succeeds, it becomes a milestone that shapes the future. Crypto Explained is about that kind of pressure, because it is where trust is tested at the deepest level. That historic transformation finally arrived in 2022, when Ethereum executed the merge, moving from proof of work to proof of stake. This was one of the rare moments where the entire crypto world almost held its breath. Because this was not a normal upgrade. This was a foundational switch. For believers, the merge was proof that the ecosystem could follow a plan, evolve, and mature. For skeptics, it was the moment they waited for Ethereum to break. What matters is that Ethereum made the transition without the network collapsing in the way people feared. And that alone added serious weight to long-term trust. Even if market price at the time still depended on bigger macro cycles, Crypto Explained calls this a trust milestone, not a hype moment. But after the merge, controversy did not disappear. It simply changed shape. People argued about how concentrated staking could become, about large service providers, about censorship risk, and about whether legal pressure could influence the network. At the same time, the scaling conversations stayed hot. Layer 2 solutions exploded, and many users moved to tools that made transactions cheaper and faster, reducing gas pressure on Mainnet. Some people see Layer 2 as salvation. Some worry it fragments the experience. But in the bigger picture, it is the sign of a maturing ecosystem. When there is real demand, solutions appear, and then people debate which path is best. Crypto Explained keeps repeating this because debate is not always weakness. Sometimes it is proof a system matters. Back to Chanel. in Colorado. By the end of 2021, he had seen his holdings rise strongly compared to his $430 entry. But then 2022's deep market decline tested him too. Daniel did not panic like Emily, because he had lived through volatility before. But he still faced the hard question, am I believing blindly? On November 15, 2022, with ETH around $1,250, Daniel decided to sell 8 ETH around $1,250, bringing in about $10,000 to lock in part of his gains and reduce risk. He kept the remaining 12 ETH because he still believed in the long-term ecosystem, especially after the merge and the growth of Layer 2. Daniel did not try to nail the top. He only tried to survive the cycle. And that survival mindset is what keeps people around long enough to witness technology actually mature. Crypto Explained respects discipline because discipline is what beats the noise. So what does this part ultimately prove? Ethereum lived through years where everything happened at once. DeFi exploded, NFTs exploded, gas fees became a constant controversy. Then the market crashed hard and crushed a lot of dreams, while Ethereum still executed a historic technical transformation. Emily represents the group pulled into a cultural wave and crowd emotion, buying in excitement and selling in pain. Daniel represents the group participating because of the ecosystem, able to tolerate volatility more, and willing to sell a portion to reduce risk. And Ethereum itself, what makes it special is not that it has no drama. It is that it keeps moving forward no matter how big the drama gets. If you have made it this far, you can see one clear truth. Ethereum is not a straight line. It is a chain of tests where trust is constantly challenged by price, bugs, controversy, and the market's wild cycles. Crypto Explained ends here with a simple ask. If you want me to keep telling the rises and falls of other cryptocurrencies in this same storytelling style, subscribe to Cryptocurrency Academy, hit like, and turn on notifications so you do not miss the next videos.